Welcome back to Reimagine 2020. I'm Yonah Hochhauser, and today I'm glad to be joined by Jonathan Caras, partner and CTO of Lionschain Capital, and a man who wears many other hats besides that. Jonathan, I'm very excited to speak to you today.
Yeah, thanks for having me.
Now, first off, want to give our audience a little background, kind of who you are and how you got into blockchain?
Sure. So I was first introduced to Bitcoin while I was studying at the Jerusalem College of Technology. I'm originally from outside of Washington, D.C. I've been over here in the Middle East and Israel for about 20 years now. I grew up as we were called script kiddies in the 90s. So writing Visual Basic scripts, plugging them into AOL and, doing various types of mischief there. So I came here as a freelance web developer, just getting interested in technology, went for a computer engineering degree, and some of my classmates were mining Bitcoin back in 2011. So I actually helped set up some rigs, but didn't really understand it or why it was something that was worth my time. Then fast forward to 2016, and I had just had an exit from a telecommunications company that I had created called Glide Video Messaging. So it was a video streaming app for your phone based on a video streaming technology that I patented. And I had some free time, and I started seeing, I was introduced to Ethereum, and I was very excited about the idea of being able to create programmable money and what that would look like to have to be able to combine the power of open source technology with the power of fintech. I had been interested in various fintech solutions, but didn't really see how you as an entrepreneur or as a startup focused person could really make headway there because of some of the heavy regulations and because of the siloed liquidity. And I saw Ethereum really presented the potential to overcome those shortcomings of traditional fintech. So I started learning more about it, and actually. I sent to one of my investors about half a Bitcoin in early 2017 or late 2016, somewhere around there, and just suggested to them that they get involved and have it as part of their portfolio. They ended up doing very well in the bull run of 2017. And so by 2018, I had somewhat inherited a Lionschain Capital once it was formed and founded and wasn't just an experiment anymore. So I joined with my two partners, Zach Wolfson and Michael Hassan, to actually focus on creating a multi-strategy a hedge fund focused on cryptocurrencies that would appeal to traditional investors and family offices based in the United States. So that was kind of how I entered into the space, just first as a hobbyist, and then as an economist or libertarian, and then eventually as a professional and technologist.
Mm-hmm. And what differentiates a crypto hedge fund from a regular hedge fund? Obviously, besides the fact that they're investing in cryptos, but is there anything inherently different running a crypto hedge fund compared to a regular hedge fund in terms of strategy, in terms of technology you guys are using, in terms of just how it goes about in terms of how you can hedge your bets?
Well, absolutely. So I think that when you're dealing with a traditional hedge fund, will often have different sectors that they focus on and that their risk managers or portfolio managers are experts at. I think one of the main differences of being in the crypto space is that you really have to wear many more hats than you would if we were just trading stocks or bonds or commodity assets. You need to be a technologist. You need to understand product. You need to understand marketing. You need to be an economist. You need to be able to have some kind of ability to be able to read the underlying code or at least run the software of the companies that you're investing in. It's much more open than the traditional markets, meaning anybody that I want to invest in, I can have access to. I can get on a Zoom call with them. I can participate in the governance calls. I can see the the pull requests on their GitHub repository, because of the fact that it's open source and that it's community driven for the majority of the projects in the space, it gives you an insight that traditional markets don't have. Another thing is that it's almost like a combination of being a venture capitalist that's investing in very early stage companies, while at the same time having access to a completely liquid market. If you take something like I'm heavily involved in the Badger DAO community, and a lot of these have very funny names associated with them. So it's relative. First of all, they launched roughly 6 weeks ago. They have almost $600 million of assets under management today. They're making about $30,000 of revenue daily, and the underlying asset, the Badger token, is completely liquid. So this is an investment advice, obviously, but there's no other space, there's no other industry that you can invest in where a product that's less than 2 months old has a highly liquid market and has hundreds of people, or if not thousands of people, that are members of the community. So by being an active member of the community, and I'm actually an admin on the Telegram group, so you get to meet the people that are the decision makers. You get to understand what their thoughts are. You get to actively participate in the community decision making. There's snapshot voting, and there's form. You can write your own suggestions for the future product vision and the roadmap. And you really couldn't do any of these things if you were a VC in the traditional Silicon Valley sense, focusing on private deals of early stage companies. And you couldn't do this if you were a Wall Street bro investing in Tesla. You're not going to get on the phone with Elon Musk, and you're probably not going to be able to impact the future of Airbnb.
Well, I think this is such an interesting topic when it comes to crypto that isn't focused on enough. This idea of fundraising, this VC, where in the traditional world, your only options essentially are to raise capital is to go to these VCs. Where here, at least we saw the ICO boom, this kind of community fundraising, and I think a lot of people got a bad taste in their mouth because while there were some great projects that did come out of the ICO boom, there were also a lot of scams and things like that. So when we're talking about the blockchain and the crypto community, early on it did seem like this promise of the community will fund everything. The community would be the one to kind of not only provide the user base, but also provide the funding. Do you think that we're past that now? Now that there are crypto hedge funds and there are the big institutions are coming in, while the community will still decide what products get used, do you think that we're past the point where the community is going to do the fundraising as well?
So I don't think institutions per se are putting money into fruits and vegetable tokens. I just don't think. I think that they're, for good reason. It's the risk profile is very different. I think that we've shifted to a model of fair launches, fair token distribution, where you don't actually buy the token per se. You actively participate in adding value to the network, and then through that you earn a yield in the native token. I think that we've also shifted from the concept of a money token, which the vast majority of ICOs focused on. And what that means, the classic example is, I'm going to make a crypto lemonade stand. Nobody actually did this. This is just an analogy. So I'm going to make a crypto lemonade stand, and I'm going to launch the lemonade token. And if you want to buy my lemonade, you want to drink my lemonade, so then you have to go to an exchange, which maybe I'll pay millions of dollars to get listed on, and then I will, you'll have to buy the lemonade token, and then you can come to my store and you can get my lemonade. The problem with that model, and in that case, you went and you found institutional investors or foreign investors or retail investors, depending upon what epoch you were at in terms of the SEC's regulatory crackdowns. Some in early 2017, 16, it was the wild, wild west, and you could raise money just on a 2-page white paper, and 2 or 3 guys in a basement somewhere. It matured very quickly, and there was a lot of crackdowns, rightfully so. And we saw that probably 99.9% were scams. So going back to the token economic model, and actually I gave a lecture on this, which you can find on YouTube for sustainable token economics at Ethereal last year. We moved away from the concept of these payment tokens, which institutional investors usually got heavily discounted, and then they just dumped on retail based on it was almost like a circular effect. You would raise a bunch of money from institutional investors. They would get a 90% discount of whatever the initial token price to retail would be. They would use some of that money to pay off an exchange, to have it listed on an exchange. They would pay other money to have it advertised on Facebook or on Google, or have promoters on YouTube pump the token. Then it would go to retail. Institutions would dump at 10x or 100x onto retail, and then retail would be caught with the bags. And then, subsequently, when the music stopped and we went into a bear market, they lost 90% of their funds, and retail did, and institutions walked away, in very much in the green. So it's a good thing that we shied away from that. What we're seeing today is much more of a concept of a token using a methodology which I like to think of as a network equity token, that there's actually a network that's being created, and essentially what you're buying is equity in that network. Usually it's not, we don't use the term equity because there's regulatory issues with that term, but it's much more common to call it a valueless governance token. And which is, if you think about what is a stock, when you buy a stock in a company on Wall Street, that usually comes with some type of governance rights. So in many cases, you have the rights to future cash flows. Those are paid in dividends. And then you can, as an investor, you can perform a discounted cash flow model. What's the market cap? What percentage of the network do I own? Because I own what percentage of tokens? What's the issuance rate? How much am I getting diluted over time? How much revenue is the protocol generating? And then how do I project that over time? And then how much of that, what percentage of that is flowing to the workers of the network, and what percentage of that is flowing to the token holders? So, and there's various different ways. It could actually be a dividend model. It can be through inflation issuance, or it could be through a buy and burn model, like if you're familiar with how MakerDAO works and how some other protocols work. So we've seen this evolution from the payment token that institutional investors just bought on the private market to really what we found over the summer was yield farming. And really the most successful version of that, or the initial version of that, was Yearn Finance, which issued 30,000 tokens. There was no pre-sale, there was no investors involved. If you brought liquidity pool revenue to the Yearn product, then you were issued governance tokens of the protocol. And then future upgrades of the protocol are voted on by the holders of those tokens. So there's many applications, Pickle works like that, Cover works like that, Badger. There's no shortage of people that are replicating that model. And I think it's a much more sustainable model, because the goal is to create a profitable entity as close to day one as possible. And much of this is focused around capturing revenue that's generated by market makers. Market makers are liquidity providers that allow for decentralized exchanges to work. I mean, it could be centralized or decentralized, but particularly within this context, we're referring to decentralized market makers. So the most popular of that is Uniswap. SushiSwap is a fast follower, and there's a few others that I'm very excited about, especially with the introductions of layer 2. Loopring actually just introduced their market making capabilities for layer 2. I think it was launched yesterday, and there will be many that will follow. And so what we're seeing now is that new protocols can launch, and if you actively participate in helping the protocol become profitable, then you get issued tokens, which are governance tokens, which will allow you to define things like What should the issuance of the governance token be? How much of the profit should go back to the token holders? What should the roadmap look like? How inclusive should the community be? What types of partnerships should the protocol be focusing on? How should the protocol advertise itself or market itself? And so you actually get to be to the better to like, in a very literal sense, you get to be a decision maker. You get to be a board member of this new protocol. And I'm very bullish on the future of these fair launches, which is really a revival of the DAO, or a DAO, a decentralized autonomous organization. And it's not so much autonomous. It's really it's really should be called like a DCO, even though that's harder to pronounce than DAO, because it's a decentralized community-led organization, meaning that there might not be any central entity, but it's the community members that make the decisions for it. And it's one token, one vote in many cases. And then it's just up to the community to look out for its own interests, to prevent rug pulls, to have good security, to pay for the proper audits, and then to ensure that interests are aligned between the token holders, the users of the protocol, and the potentially the investors, which in many cases are not investing just purely through buying tokens from capital. Obviously they could, but through actively participating and helping the bootstrap the network and make it profitable. So to go back to your question, and I know that I've said a lot, and I apologize if the listeners, if I may have lost some people. I'm pretty easy to follow.
You're saying all good. You're saying all good things.
Yeah. So if you have further questions, I'm at MadCapsLaugh. You can find me on Twitter or Telegram. But the thing is, I think that we had a fallacy in 2017 was that the users and the investors would necessarily be the same people. And that's not really the case. In many cases, it's helpful when that's the case, but there's different risk factors. There's different. Could you imagine that if the only way to use Facebook was that you had to open an account with Robinhood and then buy Facebook stock? I mean, Facebook would never be able to grow what it is today. So I think that it's healthy that there's a differentiation between owners of the protocols and decision makers of the protocols, investors in the protocols, and customers of the protocol. It's great that they all can be the same person, but I don't think that it should be programmatically forcing everybody to be all three of those categories.
Mm-hmm. And you made a good point. I mean, there was this big shift this past summer, especially with the rise of DeFi, governance tokens, LPs, yield farming. So when you're like a hedge fund or a crypto hedge fund, you had all these different investment options that aren't really available to the regular world, especially yield farming, providing liquidity to these automated market makers. Were you guys heavily involved in that? As a crypto hedge fund, is yield farming a viable return on investment? We were seeing crazy early on. We were seeing crazy high APYs. Was the APYs the draw there? I mean, it seems like you're very big into the governance tokens. So was the APYs a big draw there, or was just the governance tokens they were getting as being an LP also a big draw? Which was bigger of the two?
Well, I think that it's because it's really in an experimental phase. I think that we're seeing different. It's good and healthy that we're seeing different iterations and different people trying different nuanced permutations of governance and yield farming and other nuances along these categories. As for the fund, because of our particular risk reward profile, we're not going to ape into a bunch of degen 10,000% APYs. It's just not. It's not. It can be very alluring, and we did experiment with it with a very small percentage of our underlying capital, but it was not where most of our gains from 2020 came from. It was a very good year for us. I think it was a very good year for many people. We did about a 3x on our fund. It's, now that it's matured a lot more, now that there's, we've kind of grown past some of the industry has grown past, there's been enough cataclysmic failures through experimentation over the last 6 months that concepts like testing in production with $500 million of other people's money has fallen out of favor, thank God. And what we're seeing now is much more conservative, methodical approaches, which does negatively impact the yield that you can create, because in many cases it's a zero-sum game. You can't just make money out of nothing. And I think that this year we will allocate more of the fund, maybe up to somewhere between 5 to 10%, into farming activities. But it's still somewhat early, and we'll have to adjust based on how we communicate with our LPs, our limited partners, to make sure that it's within, that there's no surprises. You can't you can't put half of your fund in something that you hope is going to 10x in 2 months, but then the rug gets pulled out from under you, and then now you have to go back to your investors and say, I'm sorry, we lost millions of dollars of your money.
Mm-hmm. Right. I mean, especially this is such a new market, a new technology that, there's poorly written smart contracts. They're rug pullers. And there's even a lot of shady shady projects being made as well. You really have to be careful. You have to audit. You have to do your research. But do you think, now we're starting to see alongside the growth of DeFi and of this market, we're seeing the growth in insurance, whether it be smart contract insurance and other type of insurance. Are these there yet that you feel secure that hey, I'm paying for this insurance, you feel secure that you actually be covered? Are we there yet, or is the insurance just as risky at this point as the product it's covering?
Well, for sake of transparency, I'm an investor both in Cover and in Nexus Mutual, which are the two main insurance providers for smart contracts in the space. Both are very impressive teams, concepts. They have different approaches to how they solve the idea of community-driven, semi or non-regulated insurance vehicles. Both had major exploits in the last 30 days. Whether that was the CEO of Nexus Mutual being targeted in a cyber attack, which led to the loss of $8 million of Nexus Mutual tokens. And he's a friend of mine. We've met each other a bunch of times, and it was heartbreaking to see that happen. And what was so impressive was how the length that the attackers went to target him particularly. And his, compromise his individual machine and wait for just the right moment. It was, they wrote software specifically to hack his computer. It was almost like it reminded me of the attack on the Iranian nuclear reactors, obviously at a much lower scale. So that, but the unfortunate impact of that was that it really negatively impacted the ability, at least in the short term, for Nexus Mutual to provide the service that it provides. I think that that's a very short-term problem, and I think that it's because it's such a great product and has such a great team behind it. If it hasn't already fully bounced back, that it's I didn't change my position in it. Very, very bullish on the long term there. Now, in terms of Cover, Cover just had an exploit where I believe maybe it was $3 million were stolen from the contract, and that was 10 days ago. So this was actually the second time that they had an exploit. They were originally called Safe, and then they had to migrate to Cover because the Safe 1 tokens were hacked, and then whatever that whole, you can Google that to see their story on crypto Twitter and how that unfolded. But they are also a team that I'm bullish on, and even while there wasn't necessarily a buying opportunity, because when the token was compromised, they took a snapshot. So anybody that was buying the dip there wasn't going to be migrated over when they launched the new token. I actually this morning just migrated all of our tokens over to the, or not all. I think I still have some work to do there. But I'm glad to see that they're back up on their feet. But I think that that insurance is really on the cutting edge. I think reputation management is also reputation management and under collateralized loans are two areas that I think that we will see significant progress on over 2021. I actually talked to Vitalik about a year ago at a conference when he was in Tel Aviv about under collateralized loans, and he had some very interesting thoughts about how community-based, anonymous, semi-anonymous staking could be used to enable, small to medium scale under collateralized loans. And I think that we're beginning to see products come to market based on that high level vision that he outlined at that. I don't know if he came up with it there at that event, or it was the first time that I had ever heard of it. And he mentioned it when I asked him about it. But I think that we'll see, again, the core underlying, and I know I'm jumping around to a lot of different topics here, but the underlying narrative that I want to convey is that we're still in the playground mode, and we're going to see a lot of experimentation. And so you, as the investor or person that's exposing themselves to this market, has to understand that the reason that there is so much potential for gains in this market is because of the risk that you're taking on. And that's not a bad thing. You just need to position size accordingly. And that we're going to see that what attracts me and attracts pretty much everybody to the space is the fabulous community that is that has a high risk tolerance, that recognizes that what's being built here really is closer to a marathon than a sprint, that we have to have a long-term vision, and where we have to recognize that sometimes our shoelace is going to be untied, sometimes there's going to be a trap along the way, and we might fall in a pit with tigers, but we just have to climb out, and we're probably going to lose some members, unfortunately, here to there to the tigers. But as long as we keep moving forward as a community, there is a pot of gold at the end of the tunnel. And I just think I combined like 5 different analogies.
Yeah, I'm like, that's a really deadly marathon. There's tigers, there's pits, but I get the point here. It's going to be a tough run. It's going to be a long run, but I think it's worthwhile sticking through. And I agree with everything you just said. But there's one thing that worries me, and you mentioned a little bit, reputation management, under collateralized loans. Isn't there a fear that, as the market matures, inevitably, we're just going to end up where we started? We're just going to end up mirroring the traditional financial market system we have, just running on the blockchain. I mean, if we really need to account for reputation, and if you want to do an under collateralized loan, you kind of have to know how trustworthy the person is. So then it's no longer a trustless system. And I see this also a lot with a lot of the DeFi products, where it just seems to be that we're kind of just mirroring the traditional market, maybe slightly more efficiently, maybe faster, or however we want to be, maybe more secure. But is there a fear, and is that okay? Is that necessarily a bad thing if we just end up with blockchain and DeFi just ending up mirroring traditional finance?
Well, I think that that another way to look at it is that entrepreneurs that are building in this space are looking at the finance system, the global traditional finance system, and saying, what has product market fit, and how can I improve that through public blockchains? And so if you see similarities, I mean, there are similarities. You look at what have we built so far? We've built exchanges. We've built leverage trading. We've built insurance. We've built synthetic assets. We've built ETFs. All of these things have product market fit in the traditional finance world. And that's also why they have product market fit in the crypto world. It's not like just because now we have blockchain, the financial needs of a massive paying audience has automatically changed. No, it's just that we want a better system. I think the real innovation is not just inventing new services that people don't need. I think that was also a big problem in 2017, is that people said, oh, there are vegans, we should make a coin for them. There are dentists, we should make a coin for them. Where you weren't really, it's like, well, what problem are you solving? How are you doing something that provides a service that's useful for a large paying audience. So we've matured a lot more than that, and I think most of those people have left the industry. And we'll probably, with this bull run, attract a whole new generation of those guys that just want to add the word blockchain to some, cockamamie idea or whatever, and hope that they can raise money from either retail or institutional investors. But we have, we're really, I think that the main difference is the interoperability and composability. So what does that mean? Here in Israel, we have various things like Venmo. Venmo is a peer-to-peer payment. It's it's owned by PayPal. It connects to your bank account. We've got Bit and Paybox. Do you have Bit or Paybox on your phone?
I have those. Yeah, I have Bit. Yeah.
Do you have both of them?
No, I have just Bit.
Okay, so I ended up having to get both of them. I think I got Paybox first, but then I found that, look, the community that's using Paybox can only transfer with the people that are using Paybox. And the community that's using Bit can only transfer within the community that's using Bit. And there's pros and cons to each of them. There's integration with each of them, but you have to go through KYC with both of them. You have to connect your bank account or your credit card to both of them. And they're very much siloed. The liquidity and the user base is siloed. Whereas and that hurts adoption. Now, let's say that I wanted to, so composability is the concept that that tokens have a standard and that they can be used anywhere, and it doesn't matter what end user application that you're using. If I'm using Argent and you're using MetaMask, I can still send you tokens. If you're farming in Urine Finance and I'm farming in Pickle Finance, the yield that we earn, you and I can just send to each other. I can even move my LP token from Uniswap that was in Uniswap. I can just, in the click of a button, move my liquidity over to SushiSwap because there's composability. Now, in addition to that, there's interoperability or extendability, whereas if there is, and this is called the stackable Lego, the financial Lego concept, that a company or an organization like MakerDAO can come and they can issue collateralized debt, which is, you can think of as like a reverse mortgage. You have an asset that has a variable asset that has a variable fiat denominated value, such as Ethereum, and I can be issued debt against that, which is DAI, and then that DAI can be pegged to the US dollar. Now somebody else can come and say, you know what, I want to build my own application that integrates with that. Somebody like Instadap or Zerion or Zapper, they can make their own new user interface and they can extend it and add new features to it. So that it would be impossible to do that for something like Bit or Paybox, both because they, from security perspectives, from competitive perspectives, from regulatory perspectives, it's not open source code. It's black boxes, and you have to trust. You can't verify. So the main advantage that Ethereum is bringing to market isn't that they're making a whole bunch of new use cases, but they're actually making it that it's easier to advance the current use cases. That's easier for an entrepreneur to come in with, $20,000 in their pocket and a dream and a twinkle in their eye and two buddies to sit and learn Solidity over the course of a weekend or a couple weekends, and then invent something new that sits on the shoulders of everybody that built technology before them. And because it's all programmatically moving money around, everybody down the stack gets paid automatically. So you don't need to call up MakerDAO or Compound or Aave or Urine Finance and then strike a deal with them and get your biz dev person on the phone with their biz dev person and have a complex contract. You just sit and you just write something, and if it gets if it's attractive and it attracts paying customers, then you get paid, and then everybody below you in the stack gets paid. So it's synergistic, and it's almost like what happened with the invention of Linux, the open source operating system, where once there was that core product, then you could, it attracted enough people. It attracted enough people that then they continued to build on top of it and to improve it. And once you've got enough developers that are familiar with it, that keep building on top of it, then it just is a snowball effect.
Mm-hmm. And yeah, and so if pretty much everything we're speaking about, all these amazing products and opportunities, they're essentially right now mostly being built on Ethereum. And so while Ethereum has a lot of things going forward, especially with all the applications and the community and the developers, one problem that's kind of been hitting a lot is the scalability ceiling. And for many years we've been hearing about ETH 2.0. They finally launched the deposit contract for staking and the beacon chain, but there's ETH 1.0, which has all this value on it right now. There's ETH 2.0, which they're trying to build, but they want to go very slowly because they don't want to lose any of that value they have. So what do you see happening? Will Ethereum eventually actually transfer all that value over and run with ETH 2.0? Is ETH 1.0 working well enough that we're going to stay there? Or is there another competitor that's going to jump ahead and not weighed down and burdened by this fear and by this weight of all this value already locked on it, and we'll jump ahead and take the lead as the main smart contract blockchain?
So Ethereum is so far ahead in the race that they can slow down and basically walk to the finish line. But at the same time, it's their race to lose. They could screw it up. Everything could fall. I don't know what will happen when ETH 2.0 will come to market, but I think that Ethereum can have success and can reach a level of scalability without even ETH 2.0, even if ETH 2.0 is a failure. So you asked a couple questions. One was about the competitive landscape in terms of smart contract settlement layers, direct competitors to Ethereum, competition to Ethereum. And I've invested in many of them. I've got a big position in Nervous, in Solana, in Near, and in a couple others. Cosmos, I'm a big fan of. So I see the potential for all of these, and I think that we're early enough in the space that there can be a Pepsi to Coca-Cola. There can be these other networks. I think that there eventually will be synergy and harmony between these. If you wanted to, if you wanted to take the approach that it's a winner take all, then I think that these other chains, which today are calling themselves competitors to Ethereum, or alternative layer ones, they may in the future find themselves as being layer twos or side chains to Ethereum, and then Ethereum actually becomes kind of like the ultimate settlement layer that binds them all together. So that's one future potential. And another, future potential is that you have geographic areas that maybe China has its own, version of Ethereum that just overnight attracts 100 million users and is somehow promoted by the banks of China and by the social media platforms of China that they integrate, and then it just gets its own homegrown version of Ethereum or smart contract platform. So I believe that is a reasonable outcome. But in general, I'm very bullish on Ethereum itself. And I think that what we will see is we will see an introduction of side chains that will solve the scalability issue without compromising the composability or interoperability. And there's a few different players that are really leading the progression there. So in terms of layer two solutions, there is a landscape. There's a couple different high level concepts. They really break down into two different methodologies. One is called fraud-proof systems, and the other is called validity-proof systems. So a fraud-proof system will be a system where you have validators off-chain that are bringing let's, even before I get into that breakup, let's say, how do we achieve scalability? We achieve scalability by taking the expensive hard things from Ethereum off-chain, which primarily is computation and storage. We bring those off-chain, and then we perform a lot of state changes. So that could be transactions, that could be running applications, and then we take the updated state, whatever the change was, which in many cases was balances. So if I am on a decentralized exchange that's on a layer 2, so you and I might do 1,000 different trades. We do it off chain essentially for free, and then all those transactions get batched, and then the update of our balances gets sent to Ethereum and then secured on Ethereum. And now our assets never really left layer 1. I might have deposited into some deposit contract 10 ETH, and you deposited 12,000 USDC, and then we traded back and forth a bunch of times out of that, and in the end I end up with 5 ETH and you end up with 6,000 USDC. So all of those 100 trades back and forth to end up at that final state now gets written to Ethereum, and then our account balance is updated on Ethereum without the need to have processed in various blocks and paid the miners for those 100 transactions. Only the final state, and that final state might be recorded once a minute. It could be recorded once an hour. It could be recorded once a month, depending upon how secure you wanted it to be on the Ethereum and settlement layer, and how much overhead you wanted to pay. So that's the general concept of scaling Ethereum. How that can be done is you can have trusted validators that have put up a stake, basically a bounty or a deposit. And if they try and cheat, like they try and steal from you, they try and lie and say, Jonathan really only had 5 ETH, and then you had 6,000 USDC plus 1 ETH, or whatever the amount would be. If they wanted to fake a state that didn't actually exist according to our transactions in the off-chain environment, so then there would be a congestion period. And today that congestion period is usually about a week long. And if I could come, or a watchtower could come and bring data that shows that what the validator was trying to do was actually theft, that it actually didn't reflect state transitions that happened in the off-chain environment, then there would be some type of slashing event that would occur. The challenge for that is that you have to wait for the entirety of the dispute period, which again could mean that you can't exit from the system for a 7-day period. So optimistic rollup is subject to this, Plasma is subject to this, or the other alternative is that you can have a trusted bridge where you just allow for a quick exit, but it's in a fully trusted environment, which has pros and cons, but in many cases it loses a lot of the underlying value drivers that attract many people to this state. There's an alternative methodology, which is called a validity proof system, where you actually ascertain the state transitions through cryptography. That each time that a state transition happens in the layer 2 environment, that there is a proof that's generated, and then that proof can be compressed, and then brought periodically on various epochs, which again could be an hour, could be 6 hours, however frequently, to Ethereum. And then immediately upon it being processed, maybe it's 18 blocks, maybe it's 10 blocks. Once it's considered secure that you're not going to have a reorg on the Ethereum blockchain, then immediately any user would be able to withdraw from the system based on the most recent epoch that a proof was brought to the system. So there's a few different companies that are doing that. Starkware is a company that I work for that as business development that performs this. There's Matter Labs.
And they fall under the validity? Starkware
Yes,
fall under the validity?
They fall into the validity. There's Matter Labs, there's Loopring, there's Aztec. There's a number of companies that are using zero knowledge proofs, which I think the advantages to the the fraud-proof systems is that you can bring, because it's just consensus that secures it, and it's the fear of being slashed. You can actually bring the Ethereum virtual machine today to the sidechain environment, and so all of the smart contracts that are running on Ethereum today can essentially be copied and pasted and brought to the layer 2 environment. So it's very alluring for entrepreneurs that want just a click of a button to bring their current app to a layer 2 environment. And so Matic makes it very easy to transition, XDAI makes it very easy to transition, and then the various optimistic rollups, which are not in production yet, but they will be soon, also offer that same ease of migration. Zero knowledge proofs need to be rewritten. So if you want to have that layer, that security on the state transitions and the advanced logic from a cryptographic perspective, so then you're going to need to rewrite your code. And a lot of the tooling for rewriting the code is still being developed, and it's not as robust as the Ethereum tooling, which really is 6 years old in many cases. So zero knowledge proofs today is far more advanced than what it was a year ago. So I think what we're seeing is kind of a stopgap with the fraud-proof systems. And as the tooling for cryptographic-based scalability solutions, they will really take over the market, and we're going to see a transition of that happen, from 2021 and beyond. But the short end of it is that the outlook for scaling Ethereum, it has never been as positive as it is today. If you want a cookie cutter click of a button that is going to be secure but not as secure as Ethereum, that's today, it's live, you can work on that. If you want something that's as secure as Ethereum and can handle billions of dollars without exposing a fundamental change in a risk profile or a trust profile, that you're going to have, even starting today, but really I'd say it's just going to improve, and the barrier to entry is, let's say 6 months away. So all in all, I think that the outlook of Ethereum 1.5, let's call it, which is a scalable version of the Ethereum that we all know and love today, is right around the corner. And there's a lot of ways to get started with that. Actually, Starkware just released Cairo, which is a programming environment to start building smart contracts directly into layer 2 based on zero knowledge proofs. So that's a major advancement in the industry, and there's some other competitors to Cairo in the market as well. So I think that what we're going to see, and what I would challenge any entrepreneur that's entering the space today, is to take a good look at what it takes to build from day one on layer 2, because it's far more laborious. It's more expensive to first build on layer 1 and then find out that you hit a wall because of scalability issues, and then have to go through the headache of migrating to layer 2. There's a lot of great resources out there. There's even workshops. The Cairo now has workshops that are happening on a regular basis. So it's very exciting to see layer 2 really hit the market full steam.
But and this is the last question because we are running out of time, but if layer 2 is running on consensus with the same security as Ethereum, cryptographically, wouldn't it end up in the layer 2 hitting that same ceiling eventually that layer 1 hit?
Well, no, because it's just like how, the ultimate way to scale is through sharding. And layer 2 doesn't need to all run on essentially one computer, whether that was a virtual computer that was, distributed all over the world, or, literally on one computer, like some of the, today, some of the fraud-proof systems are. So what you end up with is that I could run my own network using a validity proof system, which has all the scalability that I need. It could handle, 50,000 transactions per second. And then you could run your own, which handles your own 50,000 transactions per second. And then, another guy down the road or gal runs their own. And so we all basically, it's essentially sharding. But it's sharding that's much more flexible and not formalized. And because we're all using the same language of proof systems, that we can actually pass proofs back and forth from each other, which then allows us to transfer funds without ever having to go trustlessly, without ever having to go back to layer 1.
So 2021 is the year of the layer 2 scaling.
Yep, absolutely.
All right. Very exciting, Jonathan Caras. Thank you so much for taking the time and giving us your thoughts. Always interesting as ever. I appreciate you talking with us. Cairo, I'm excited for it. Maybe I'll go play around with it after this talk. And for all our viewers here at Reimagine 2020, I'm Yonah Hochhauser. Thanks for watching.
Yep, thanks. It was fun.